So I'm very bullish China, particularly after COVID-19. Although China was the first economy to experience COVID-19, it was also one of the quickest to respond. At one point, there were 11 million people locked down in Wuhan, and that was 2 days before Chinese New Year. Mask wearing was made mandatory, and I think they were building hospitals in like 10 days. In this video, I want to talk about my number one Chinese stock pick that I think will profit from continued Chinese economic growth, and it's also going to come out of the pandemic a lot stronger. So stick around and let me know what you guys think. So let's start with why I'm so optimistic about the Chinese economy. There's a really good article that was released towards the end of 2020 on BBC News. In this article, it stated the Chinese economy is planned to overtake the US, which is currently the world's largest economy, by 2028. And that was a result of COVID. If we scroll down, we can see that that forecast is actually 5 years earlier than was previously forecasted. And further down, it states the reason for that is because China controlled the disease through swift and extremely strict action, meaning it didn't have to repeat paralyzing lockdowns that we witnessed in Europe and the US. There's a really good graph later on in this article, which shows the Chinese economy in red and the US economy in blue. As we can see, the Chinese economy overtakes the US around 2028 and then continues to grow to 2035 and is around $10 trillion larger than the US is in that period. That's about the same difference between the US and Chinese economies in 2010. Or in other words, China's economy is going to be bigger than the US in 2035, as the US economy was bigger than China in 2010. We're seeing some of this play out already. In fact, it shows here that unlike any other major economy, the Chinese economy actually grew in 2020. This is why I am so bullish China, because I think this continues to play out and China increases in economic importance around the world. China isn't the largest economy in the world. Its e-commerce market certainly is. It states here China's e-commerce sector is more than 3 times the size of the US market. And also that the e-commerce market makes up for about 35% of total country retail sales within China. So I did a bit more research. China's retail sales as of January 2021 were about 39.2 trillion yuan, or $6.05 trillion. And Chinese GDP, with a quick Google search, was about $14.34 trillion. Now granted, this is slightly dated because it's 2019 data. So let's whip out our calculators real quick. In this article, we found that Chinese retail sales are at $6.05 trillion. So let's plug in $6.05 trillion. Divide that by total Chinese GDP, which is $14.34 trillion. This means that about 42% of Chinese GDP is made up of Chinese retail sales. Let's go one step further and back to the original article. If 35% of that is made up of e-commerce sales, this implies 14.8% of Chinese GDP comes from e-commerce sales. That is a very, very large number, especially when you consider, as we discussed in the previous section, the forecasted growth rate of Chinese GDP, and considering the e-commerce sector is already the largest in the world. This implies massive upside. Now, there are 2 unique features of the Chinese e-commerce market. The first is a lot more sales take place on mobile phones. In fact, 80% of all retail sales occur on mobile devices in China versus only 64% globally. The second unique feature of the Chinese e-commerce market is that mobile payment platforms are very popular. In fact, it states here more than 80% of smartphone users in China use mobile payment platforms compared to only 27% in the US. So in order to have a successful Chinese e-commerce company, you need to be able to have a strong mobile presence and the ability to process mobile payments. And so when I started to look through a selection of Chinese e-commerce stocks, I actually had a really easy time picking the winner. And that was because there's one company that stands out far above the rest, and that's Alibaba. Alibaba trades under the ticker BABA, as you can see here on Yahoo Finance. And the reason why I think it stands above the rest is because it is by far the biggest. If we look through the main operators in the Chinese e-commerce space, Alibaba has 60% market share, primarily through its two sites, Tmall and Taobao. Tmall is the third most visited site in the world, and it's a business-to-consumer marketplace. Alibaba also controls a mobile payments platform called Alipay through its ownership of Ant. Alipay has 55% market share of China's total mobile payments markets. The rest of this is controlled by Tencent. So in both regards, Alibaba has a very strong position. It has 60% ownership of a retail market, and it contains a 55% ownership of a mobile payments market. These two things make Alibaba a very strong proposition, with a natural monopoly on being able to sell retail goods and also being able to process its unique and proprietary mobile payment. At this point for me, Chinese e-commerce seems like a zero-sum game. Companies like Amazon do really well in Europe and the US because you don't just use them for one specific item. I mean, think about it. How often have you gone on Amazon to buy a book and then ended up buying an electronic item or something for your house or car? In China, you have that, plus you also have mobile payments. It's like me saying you can only use your credit card on a specific website. So to go to another website makes it even harder because then you have to go and set up another credit card. You have to get used to using another website. In China, Alibaba is not just an Amazon, but it's also a bank that facilitates purchases on Amazon. So customers are going to be very sticky, and I think Alibaba has to maintain a large amount of the market share as a result. So not only is Alibaba a natural monopoly, I also think it's a better business, and it's trading at a relative discount to its peers. As we covered in the previous section, Alibaba has about 60% market share, and 25% is made up of JD.com and Pinduoduo's market presence. If we compare Alibaba to these two companies, we'll find that Alibaba is a much stronger business, and I'll explain why. Alibaba's profit margins are 24.7%. That is very high, particularly when you compare that to JD's 4% and Pinduoduo's negative 17.27%. The reason for that is because Alibaba allows businesses to sell to consumers using Alibaba's platform and collects a fee in return, whereas JD and Pinduoduo sell directly to the consumer. Selling directly to the consumer means you have to hold inventory, it costs more, you have more operational costs, versus just allowing someone to go on your website to sell directly to a consumer. It's a much leaner, low-cost business model. So there are two other things I really like about Alibaba. The first thing is it's trading at a lower price to book value than its closest competitors. And the second thing is that it has a very high current ratio, which is current assets relative to their current liabilities. This means that Alibaba is able to withstand a decline in consumer spending, but also has the financial flexibility to make new acquisitions or to make new investments. Let's start with the price to book value. If we look on Yahoo Finance here, we'll find Alibaba, as of the latest results, has a price to book value of 4.93, i.e. new investors today are paying a premium to the actual book value of 4.93 times. You're paying 4.93 times what the fundamental business is worth on paper to own this stock. When you compare that to a company such as JD's price to book value is 6 times, whereas Pinduoduo's price to book value is 46.5 times. So Alibaba is the cheapest relative to its price to book value. The second thing I like about Alibaba is that its current ratio is the higher of the three. So the current ratio for Alibaba is 1.67 times, JD is 1.2 times, and Pinduoduo is 1.4 times. So Alibaba has a stronger balance sheet and is trading at a relatively cheaper valuation compared to its peers. Whilst Alibaba is trading at a discount relative to its Chinese peers, it's also massively undervalued relative to its non-Chinese competitors, particularly its competitors operating in the US and Europe. If we compare Alibaba's price-to-book ratio of 4.9 times with a company such as Amazon, it looks significantly cheap. Amazon's trading at 17.8 times. eBay is also trading at 13.33 times. These companies clearly command a much higher premium than Alibaba, and to a large extent, I think it's unwarranted. Alibaba has a stronger market presence defined by market share than Amazon or eBay have of the US market share. In fact, Alibaba's market share of the Chinese e-commerce market is larger than eBay and Amazon combined in the US market. One reason why Alibaba is trading at a discount to its peers is because of the impending investigation by the Chinese authorities, particularly around Alibaba's supposed anti-monopolistic practices. This is in relation to Alibaba restricting certain vendors on its platform from using other platforms to sell their goods. The Chinese regulators also cancelled the planned IPO of Ant Financial, which is 33% owned by Alibaba and also owns the Alipay mobile payments platform. Now, this has clearly damaged investor sentiment, and there is a lot of uncertainty. This boils down to 1, your risk appetite as an investor, and 2, what you think of the Chinese government's interests. I think Alibaba is trading at a discount to its peers to reflect the fear factor that the Chinese authorities may come down hard on Alibaba, which will lead to financial repercussions. At the same time, I don't think the Chinese regulators or the government want to take down Alibaba, as I don't think that's in their vested interest. So to conclude, if you're bullish China, then I think you have to be bullish Chinese e-commerce. And if you're bullish Chinese e-commerce, then I think you have to be bullish Alibaba, because that's about 60% of total e-commerce sales in the country. I think now is an opportune time to invest in Alibaba because it's trading at a relatively low valuation compared to its Chinese peers, but it's also massively discounted compared to its non-Chinese competitors. As always, please let me know what you think by leaving me a comment. And if you thought this video was helpful, please drop me a like and subscribe so you get to see my new content. Thanks once again.